Okay, welcome back for chapter 11, property, capital gain and losses. We covered up to this point, I believe, last time. Let's keep going. It's a lot of material that still we need to cover, but let's see how far we can go anyway. After the lecture, we try to prepare some tax returns, okay?
Is that website active, the Lincoln Learn?
The
Updated?
Lincoln Learn will get updated after normally November 15th.
Oh,
So still is early. November 15th and later. So here says when capital losses exceed capital gains, then what do you do with the losses that you have? The excess is net capital loss, right? So you take the net capital loss each year up to $3,000 and you offset it against your ordinary income. So you cannot offset all of that unless you have a net capital gain the next year. And then, yes, you can use as much as necessary. But against ordinary income, you can use only $3,000 each year. If it says if it's merit filing separately, it's just $1,500. So this example maybe help us a little bit. So in 2022, Mo sold 3 capital assets that produce a $4,000 short-term gain and the $13,000 short-term capital loss and the $2,000 long-term capital loss. So we have 3 properties, looks like 3 assets. We have short-term gain, short-term loss, and then we have just long-term loss. So we net them first individually. In regards to short-term, 4,000 minus 13 gives us minus 9. That's loss, short-term loss. On the other side, we have just $2,000 capital, long-term capital loss. So most capital losses exceed capital gains by $11,000. He uses $1,500 limit for merit filing separately. Here says merit filing separately. You see the last line. Otherwise, it would be $3,000. But because it's merit filing separately, he will use $1,500 of net short-term capital loss to offset ordinary income in 2022 tax return. Mo carries over to 2023 as $7,500 of loss and $2,000 of long-term loss. So $7,500 short-term loss and $2,000 long-term. When you are using this against your income, ordinary income, remember, you first start from short-term loss. Make sense? Not from long-term loss. Because you can, how much you can use here for a merit filing separately? $1,500 loss against your ordinary income, like W-2 income, those type of things. But that $1,500 loss, where is coming from? Is it coming from this 9,000 or is it coming from this 2,000, right? So guess what? You have to use the short term first. And after it's exhausted, then you can use long term. Make sense? That's why we take $1,500 from 9,000. Okay, 9,000 minus 1,500. It will be 7,500 short-term capital loss carry forward And this 2,000, we didn't touch it, so we're gonna carry forward that also. Make sense? And again, software will do it for you. Software knows all these rules. Okay, don't think, oh, I'm gonna memorize the whole thing, and how about if I forget? Fortunately, software is helping us. Understanding the concept is really good, but you don't need to memorize this. I don't memorize this. I prepare the taxes, and the tax will prepare me whatever is carrying forward to the next year, as it is, and that's it. I'm done with my tax return. In case I want to look at it, if I look at the details, I will see that how much I'm carrying forward. 7,500 short-term loss and 2,000 long-term loss. Okay, so don't panic. Heather is single. In 2022, she sells 3 capital assets that produce a $5,000 short-term capital gain and $1,000 long-term capital gain, and a 4,000 long-term capital loss. So from previous year, we have a carryover of 6,000 short-term loss and 2,000 long-term loss. This year, we have 5,000 short-term gain, 1,000 long-term gain, and 4,000 long-term loss. So that's good. So we put it under each other. So 6 minus 5 is 1,000 short-term loss, and 2 plus 1 minus 2 plus 1 minus 4. That's minus 5,000. That's a loss. 5,000 loss long-term that we have to take it, forward. Heather is going to use, okay, out of this 1,000 and 5,000, how much can you write off against your ordinary income? $3,000, right? Okay, which one do you use first? Short term first. So we're gonna go take this short term loss of $1,000 first. And we have another $2,000. We go and pick it up from here. So this short term will completely go away. And this long-term capital loss will become 3,000 left. So what would we take it to the next year, carry forward? Only 3,000 long-term capital loss will be carried over to the next year. Make sense? Okay, so one more time. Because you can use only $3,000 for ordinary income write-off. You start from short term, pick it up as much as you can. In this case, we have just $1,000, so take that. The remaining, now you go to the right-hand side, pick it up from long term. The same example, again, continuing, Heather sells 2 capital assets in 2023. So that was, let's say, previous year. Now in 2023, Heather sells 2 capital assets. Those assets produce a 14,000 long-term capital gain and 2,000 short-term capital loss. Remember, she had already $3,000 carrying forward, right? Capital loss. Okay, that's carryover. This year we have 2,000 short-term loss and 14,000 long-term gain. Again, put it under each other and start netting. So 2,000 loss short-term goes down and eventually goes to the right-hand side. For the long-term, minus 3 plus 14 is 11. 11 minus 2,000 coming from the left side. So it gives us 9,000 long-term gain. Heather used the 3,000 long-term capital loss carryover from 2022 to offset the $14,000 long-term here. You see, we offset that. She then offset $2,000 net short-term capital loss coming from the left side against the long-term capital gain. We end up with $9,000 capital gain, and that will be taxed at what? We're not going to carry forward this. It's a gain. As soon as you have a gain, IRS wants tax, right? And what will be the tax bracket for this? Anyone? 0%, 15%, or 20%? Long-term capital gain tax. 0% if you make below a specific threshold. I think it's about $44,000 now. If you make more than that threshold, up to about 500,000 something, you pay 15%. If you make more than that, 500,000 annual income, then you pay 20%. Okay, continuing with the same problem again, same fact as example 15, except that instead of $14,000 long-term capital gain in 2023, Heather incurs a $14,000 long-term capital loss. Okay, so now what? Remember that carryover was $3,000 from previous year, but now we have 2,000 short-term loss in this year plus 14,000 long-term loss. So we net it. We net it, and then we end up by having $2,000 on the short-term loss and 17,000 long-term capital loss. Since the netting between two groups result in both net short-term loss and long-term capital loss, the netting process is over. No more. You stop right there. Either use the $2,000 short-term capital loss and the $1,000 of long-term capital loss to offset the ordinary income. Why? Because you can only offset up to $3,000 of ordinary income each year. So you go to the short term first. That's the rule. Take that as much as you can, which is $2,000. So you need a little bit more. You go to the right-hand side to the long term, pick up another 1,000 from there, and you write it off against your ordinary income to pay less taxes. So leftover is just $16,000 long-term capital loss carry over to the next year. You good? And individual taxpayers report the detail of sale of capital assets on Form 8949, sales and other disposition of capital assets. They then transfer the total to Schedule D, and then from Schedule D goes to eventually Form 1040. Yes. So it doesn't go to Schedule 1 to technically Schedule 1 I was referring to. It doesn't go to Schedule 1, then Schedule 10. It goes straight to Schedule 10 because we have line 7 specifically for that purpose. Got it? Okay. So here we have an example for it that gives us some information when you purchased the property and what was the proceeds and what was the cost basis And you take all this information and then you take it to the Form 8949, details of assets that you sold. And here is gonna say part 1 is for the short term, and probably part 2 is for the long term. We're gonna look at it. So here you check the box that it applies. Short-term transaction reported on Form 1090B showing basis wasn't reported to the IRS. If that's the case, then you go check the B. If it's reported to the IRS, then box A should be checked. And when you fill up the form, doing this in the software, it will ask if this was reported to the IRS or not. If it's your property, you never report it to IRS, but if it comes from 1099B, then most probably whoever is giving you that, they send IRS a copy of that. If it is not reported on 1099B, then you'd obviously check C. And part 2 is the long term again. You have to again check one of those boxes, say what type of property it is, date purchase, date sold, how much did you receive, what was the basis, the difference of sold and basis will become gain or loss.
How do you know if the 1099B was reported or not?
If you get a 1099B, there is a box that says for reported to the IRS. And that's why I said whenever you receive a form, check everything. Make sure whatever it's on the form, transfer it into software. And every single thing on the form, the moment you transferred it, with your pencil, put a check mark next to it. Because if something happens at that moment, someone asks you a conversation or question, 5 minutes later, you say, did I enter this or not? But as soon as if you have a pencil with you, every single box that you enter it into the software, immediately put a check mark next to it on the copy of that 1099B that you have. Don't put it on the original, I suggest. Make a copy of all the things. But in case if it's your tax return, then do it on original, who cares? But if it's a client, I suggest don't put anything on the originals, just in case client wants to get all the originals back. You don't want over there, leaving any marks on the original documents. That's why when we prepare taxes here, we get the actual documents, we go all the way to the copy machine, we make a copy of it, we come back, the copies are in the file, the originals, we give it to client, we say, put it in your bag, please, and we visually check till they put it in the bag. As soon as it's in the bag or the purse or whatever they have, clear, then we say, okay, let's do the rest of things. Because very easily they say, no, you didn't give it back to me, or where's my social security card, or whatever. So, and one more thing, always check the copy machine. Because normally you leave the last one in the copy machine. Okay, so here is the schedule D that has been filled up. Part 1 is the short term, says how much gain or loss you have. That's the proceeds, that's the cost, comes from the other form. And here is the long term. You see the line 6 here? The line 6 is the carryover that you have from previous year. So if you have a carryover, you net them right here. So 2,205, but we have a loss carryover. So our gain is just short term 1205.
Will the system tell you that there's a carryover amount, or is that something that we have to calculate and know that there's a carryover?
This is the point. Is this your return client? And you are doing the same thing on the same software over and over, then yes, everything is right there. But if it's a brand new client, all of a sudden, then you say, okay, bring me your last year tax return.
But I'm saying, like, if I'm doing it for the first time, and this year they will have a carryover for next year, will the system tell us that they will have a carryover for next year, or will?
Yes,
Okay.
yeah. First, let's say it's a new client. First, you need to look at the last year tax return and see if there is any carryover or anything. While you are doing these type of things, there is a place that says, what is there any carryover loss? Is there any short-term loss carryover, short-term, no, long-term loss carryover? Then the answer is yes, and enter the amount because it's a new client, right? So enter the amount. So you have to look at the physically on the tax return and enter it. And then you finish the whole thing all the way to the end. You, let's say, print the tax return. Moment you print the tax return, all the schedules are there. Next carryovers are there. A schedule of depreciation is there. A schedule of depreciation for the next year is there. Make sense? So you will have two types of schedule of depreciation for the year that you are doing and the year that is coming. The year is coming. Why is it important? Because in case that client goes to another tax preparer, then the other tax preparer needs to know, okay, how much did you depreciate? Where is your schedule of depreciation for last year, for this year? What should I enter? So the new tax preparer is completely blank. He has no idea what he's doing. So you have to give him the last year tax return. That's why if we have clients here, the first question is, do you have your social security card, W-2s, blah, blah? Yes. How about your last year tax return? And most of them, they say, oh, yes, I do, or no, I don't. Normally we say, when we kind of need it, maybe not, depends how complicated your tax return is. But if there is anything in your last year tax return, you don't give it to us, and we just prepare this year tax return blank, then it will be blank. It might be something shortcoming. But we have to tell that to client, because otherwise they say, you didn't tell me that. You are the professional. How come you didn't tell me? You should have told me, go home and bring it. That's normally what I do. I say, I suggest, we can start, but come back next week with your last year tax return and see if something is. But sometimes they say, no, I didn't have anything. I had just a W-2, nothing else, or something like that. Very simple. Then I say, okay. Yeah. And our VITA program, again, they don't have complicated things. We don't have depreciation schedule, those type of things. So normally our clients are kind of simple clients. Okay, so let's keep going. Worthless securities, it is worthless when it is worthless, okay? So you cannot just say, I guess it's worthless. It has to be actually worthless. And also when it goes worthless in the middle of the year, having sold the security for zero, worthless means you sold it for $0. And also it means you sold it at the last day, December 31st. Yes, maybe it was worthless in the middle of summer, but from point of selling, it is last day. So here is Rudy pays $10,000 for a stock in April of 2022. Rudy, on January 23 of next year, 23, like maybe 9 months later, the stock is declared worthless. Rudy is deemed to have sold the stock for $0 and on December 31st of 2023. Since the period from April 4th through December 31st exceeds 1 year, then it's a long-term capital loss. He reports the loss in part 2 on Form 8949. Part 1 is short-term, part 2 is long. Section 1244 stock, it comes from qualified business stock, which is not that much common. Qualified business stock needs a few requirements to be qualified as that. So it's not that much common. You can read this later on just for fun. I've never had a client to do this, so it's something that is good to know, but God knows even if you're going to see anything like this in it. So here's an example about that. So Paige, who is not married, sells Section 1244 stock, which is small business, qualified small business stock, for $17,000. Paige purchased the stock several years ago for $80,000. Her realized loss equals $63,000. You see that? 17 minus 8. Paige recognized a $50,000 ordinary loss. That's what you can do for qualified business stock. And a $13,000 long-term capital loss. So the first $50,000 can go towards the ordinary income loss. That's the benefit of that type of stock. But not more than 50. So therefore, the rest will become long-term capital loss. She enters the long-term capital loss into netting process and uses the ordinary loss, which is very good, to offset ordinary income like W-2s. If Paige has no other capital gains or losses, only $3,000, remember, you can use every year, right? So not only is gonna use that $50,000 permitted ordinary loss, also $3,000 from that 13, 3,000 out of that 13, as a wash against ordinary income. So technically, she is going to use $53,000 to write against ordinary income. And if the stock is not qualified for Section 1244, then Paige would have recognized a $63,000 long-term capital loss, which she needs to carry over for many years, right? And here says that the limit is 50,000, right, for a single person. So 50,000 for a single person that you can write it against ordinary loss. That's good. But you can do a little bit better than that. So instead of following this rule, this situation, taxpayers whose Section 1244 stock has declined in value more than $50,000 from when they bought it, it should plan on selling their stock over more than 1 year. Why? Because every year you can write it off against ordinary income up to $50,000. So, for example, Paige from this example 18 could have done a little bit better job. If Paige has sold just enough Section 1244 stock to produce a $53,000 loss, not more than that, she would have been able to deduct entire loss, which is $50,000 against ordinary, plus $3,000 that normally you have permit to use against ordinary loss. That would be enough for that year. She could then sell the rest of the stock next year and deduct the whole thing again, whatever is remaining balance against ordinary loss, because up to $50,000 is permitted, plus $30,000 every year. Make sense? So every year, she could have done that in stages, so she can take advantage of writing off ordinary income instead of carrying over to the next year. Okay. Related parties. Okay, let's read some of these examples. So Aaron sells property to a corporation for a $10,000 gain. Aaron owns 60% of stock in the corporation. The property is a capital asset to Aaron, but will be depreciable asset in the hands of the corporation. Aaron recognized $10,000 of ordinary income. So the problem here is saying is if you have a capital asset and you sell it to a corporation, then corporation can depreciate that, and that depreciation would be benefit to write it off against ordinary income. So therefore, Aaron recognizes $10,000 gain also as ordinary income. Same fact as example 19, except that Aaron owns 50% of the stock in the corporation. Because he's involved, you see what I mean? This is conflict of interest. That's why the percentage is the important thing. Because he does not own more than 50% interest in the corporation stocks, Aaron recognizes $10,000 capital gain on the sale of property to the corporation. So the percentage of ownership, the threshold is 50% or less. In that case, it's a capital gain and he can recognize a capital gain. And why a capital gain is important again? Because capital gain has a favorable tax rate, 0%, 15, and 20. Remember, based on your income. Same fact as example 19, except that property is land and therefore is not depreciable property in hands of corporation because land never depreciates. So Aaron recognizes a $10,000 capital gain on the sale of land. Doesn't matter what the percentage might be because it's not depreciable property. And why we have this issue? Because people who have equipment that it might be a capital gain, they want to sell it to their corporation that they own in order to use it as like write it off as a depreciation expense and write it off against ordinary income of the corporation. That's much better tax saving compared to recognizing a lot of ordinary income and paying high rate of tax rate. Okay, subdivided property, you can read it. It is a few issues and details. So it's not that much common. So you can actually just study it as a form of knowing it, but depends when you come to the such a point, you have to again read it again. Let's go to non-business bad debt. In chapter 7, describe the rules for deducting business bad debt. You know what the bad debt is, right? Bad debt expense. Bad debt expense, that means you recognize accounts receivable, right? And you recognize income. Okay. Yes. When you provide a service to someone, you send them an invoice. Bookkeeping, right? What's the journal entry? You send them an invoice, you recognize debit accounts receivable, credit sales revenue. Okay, moment you record sales revenue, then IRS wants you to pay taxes, right? But then few months later, next year, that person who you provide services and you recognize sales revenue didn't send you any check for that invoice, and he went bankrupt. So IRS says you cannot use allowance method to recognize bad debt expense, which we do in bookkeeping for to follow GAAP. IRS says don't recognize bad debt expense like that using allowance method. Using allowance method, again, to just give you some hints, on December 31st, you estimate what would not be collectible based on history of your business and the experience you have, and then you debit bad debt expense and recognize allowance for doubtful account. But that's for bookkeeping and following GAAP. IRS is not permitting you to do that. So that specific bad debt expense that you recognized in December 31st as an estimated possible situation is not acceptable. IRS says only you can recognize bad debt expense when it happens. And that means you have to wait. So in chapter 7, describe the rules for deducting bad debt expense when it happens. A non-business bad debt is a bona fide debt that is not a business bad debt. It's a personal bad debt. A non-business bad debt is reported as a short-term capital loss, regardless of how long the debt was held. This differs from business bad debt, which sole proprietors deduct on Schedule C. Also, unlike a business bad debt, taxpayers cannot deduct a non-business bad debt until it becomes completely worthless. You have to wait till it goes completely worthless. That means the person needs to do bankruptcy. If the person is not doing bankruptcy, you have to take him to court. Let's say your friend borrowed from you and he didn't give you back. You have to take him to court to collect your money, unless he files bankruptcy. In that case, you can recognize bad debt expense. In the year taxpayers claim a non-business bad debt, they enter the name of debtor and the board statement attached on Form 8949. Part 1, in the attached statement, they include what? Number 1, the amount of debt and the date it was due, the taxpayer's business or family relationship with the debtor, let's say friend, that taxpayer's efforts to collect the debt. What did you do? Let's say I took him to court. Taxpayer's reason for concluding the debt was worthless. That person filed bankruptcy. Pam made a bona fide loan of $10,000 to her friend in 2018. In 2021, the friend filed bankruptcy and Pam was told to accept 60 cents on the dollar for her loan. Better than nothing, right? So Pam received $4,500 from bankruptcy court in 2022. Pam recognizes $5,500 short-term capital loss in 2022. So it's gonna be short-term capital loss no matter what. Doesn't matter how many years is passing. The year in which $5,500 became worthless. Okay, let's look at this casualty and theft gain. Let's look at this example. It will, I think, help us. So Val home was burglarized. A family heirloom and a TV was stolen. Val's holding period in both items was long-term. Information about the items reveals the following. So they lost a TV. The original fair market value before the issue was $500. After the incident became zero. Adjusted basis for that TV was $700 original purchase price, let's say. And insurance proceed was zero because the TV was not insured. Heirloom, before the incident, was $3,000 fair market value. After the incident was lost, so it's zero. And adjusted basis, when they purchased that, for some reason, after depreciation, whatever, it was $1,000. So insurance, it was insured, so insurance gave them $2,900 for that. Since Val did not insure the TV, the theft of TV produces a $500 casualty or theft loss, lesser of 700 basis or decline in value. So which one is less? 700 or 500 before theft. So 500 is less, we go with that. That's a $500 casualty or theft loss. Val insured the heirloom, which results in $1,900 casualty or theft gain. Why? Because they received $2,900 from insurance proceeds, but $1,000 was adjusted basis, right? So the adjusted basis was less than fair market value. So that's the difference, that whatever insurance gives you, less adjusted basis of $1,000, that's $1,900 gain from insurance proceeds, right? So while net casualty or theft gain equals $1,400, $1,900 gain from insurance proceeds, whatever you got over the adjusted basis, minus $500 loss from TV. So Val treats the $1,400 as a long-term capital gain in the netting process, since the both properties have been held long-term. And long-term capital gain, you use it for netting process, but assuming there is no other thing to net against it, then $1,400 will be taxed based on either 0%, 15%, or 20%, depends on the income of the taxpayer.
I'm kind of confused about, like, you're not supposed to, like, when you buy a TV, you're not reporting that as like some sort of asset on your taxes, right?
No, it's not
So this is
asset,
just-
but when it's lost, right?
So where's that adjusted? I don't totally get where the adjusted basis is, how that's being computed.
Adjusted basis, it's when you bought the TV, how much did you buy it?
Right,
$700 many years ago, right?
but it's adjusted, so it sounds like it wasn't bought for 700 and depreciated to 700.
When it says adjusted basis, it means at that moment, the basis. It might be depreciated, it might not be depreciated.
Well, who determines that? How do you figure that out? Like,
Okay.
TVs, I imagine, probably have, like, how do you even know what is?
Okay,
the life-
TV for sure, you cannot depreciate that, right? Because it's in your family living room.
Yeah,
Make sense? But let's say you have something else that you use partially in a business, like Schedule C type of business, partially for personal use. Let's say your car.
yeah,
So you partially depreciate that for your business, but partially not. So then you have an adjusted basis. So your adjusted basis is not the original purchase of the car. The car, you bought it for $50,000, but you partially depreciated for $10,000 because of your business use. So now what's the adjusted basis of the car? It is 50 minus $10,000 depreciation. So adjusted basis is $40,000. So this heirloom maybe has an adjusted basis because has been depreciated partially for some reason. And IRS knows that if you are using something for partially business, partially for personal, then how much has been depreciated?
But
They-
these are only personal things. These aren't partial. These are just personal items. I'm just confused at where you come, like where they come up with these numbers. And if somebody comes to us saying, hey, my TV was stolen this year,
Okay,
what am I supposed to tell them?
TV, if it's stolen, then how much did you buy? Do you have receipt for it? Let's say for insurance thing, if you have TV or anything else, you know that. Of course, people are not doing it, but you know that you need to have a picture of it, have the receipt of it.
Saving all these receipts. These
I
are
know,
like
but for the purpose of,
taking a.
yeah,
loss.
let's say we have people in Texas this year that has been declared as disaster area because of, let's say, I don't know, water damage or whatever, or storm, whatever.
Mhm.
So now insurance is paying you money, right? So you normally need to say, okay, what do I have? And if the insurance is paying you a lot of money above your adjusted basis, then you are making money at that case, right? And most of times you have a loss, casualty and theft loss. So if it's a loss, it's okay. But if it's a capital gain involved, like this scenario, as you see, adjusted basis for these two things are $700 and $1,000. And the adjusted basis of $1,000, they got $2,900 from insurance company. And why insurance company gave them $2,900? Because insurance company says the fair market value before destruction was $3,000. So that's why I'm giving you $2,900. That should be fair. And okay, it is whatever it is. So now you have $2,900 coming for something that it's adjusted basis of $1,000. So technically you have a gain over there, capital gain. Okay. Taxpayers compute their net personal casualty and theft gain or loss on Form 4686, Section 8. If the result is net gain, taxpayer transfers personal casualty or theft gain and losses to the appropriate short-term, long-term lines in Schedule D for taxable years beginning after 2018, and net personal casualty loss is only deductible if it is federally declared disaster area. So like I get updated from IRS for tax update. If you are tax professional, you need to also subscribe to that. So as soon as somewhere is federally declared disaster area, I get an email. IRS declared Texas recent storm area as a disaster area, or California recently fire X area as disaster area. So you can, if it's a disaster, why it is important? Because you can, at that point, you can record your personal casualty loss and take advantage of that to pay less taxes.
This is kind of a silly question, but the loss has to be related to that
Casualty,
disaster then, right? It's
theft
not
or
like-
casualty loss, yes.
Okay,
Yes, has to be related. it's not business. If it's business, then we have business casualty
Yeah,
loss,
yeah, yeah.
which we learned in previous
Well, I'm
chapters.
just thinking like if an area is declared a, disaster area for some reason, but as a total side note, someone came and robbed you. Like, can you take it just because your area was declared a disaster area at some
If,
point in that
again,
year?
if it's not declared disaster area, since 2018, after Trump changed the tax rules, we don't have this casualty theft loss
Anyway.
write-off. But unless it's federally declared. So if that's federally declared now is the only hope that you can write it off.
Right.
Before than 2018, it was whatever loss you have minus $100, and you can put it in schedule. I think schedule A somewhere as a casualty loss after $100 for each incident deduction. Let's say your loss was let's say your loss was $1,000 minus $100 each incident deduction. I don't know why they came up with that $100 number, and then $900 would have been casualty loss. But now we don't have it. Since 2018, we don't have it till all the way to 2025. Okay. And after that, we don't know what's going to happen. Okay, let's go to section 1231. Last time we covered section 1231 properly, I believe. It is, if you like to look at it, it will be in module 11, I believe. Here, module 11, advanced topics, section 1231, 1245, and 1250. That's where we referred to now last time. So bottom line, everything is section 1231 as a kind of property that's used in a trade or business. As soon as you understand that part, then 1231 might end up to become either 1245 or 1250. So 1250, generally, it's a real estate property, like building and rental houses, those type of things. And 1245 is things like furniture, business equipment, fixtures, carpeting, automobile, those type of things are 1245. So 1250, something like real estate that depreciates for a very long time. But 1245, it's other things that normally depreciate for 3 years, 5 years, something like that. So let's look at some examples. For the year, Daniel reports $12,000 section 1231 gain and $5,000 section 1231 loss. Daniel's net section 1231 gain equals 7,000. So 12,000 gain in here, 5,000 loss in here. So 12 minus 5 is 7,000. Daniel might be able to treat this amount as a long-term capital gain in the netting process. So long-term capital gain is good. Why? Why long-term capital gain is good compared to ordinary income? Because you pay either 0%, 15%, or 20% favorable tax rate based on your income. For the year, Morris reports $10,000 section 1231 gain because of sale of one of those properties, and the 23,000 section 1231 loss. So gain is 10,000, loss is 23. Morris net section 1231 loss is 13,000, right? He deducts this amount from gross income as an ordinary loss. And this is another fantastic thing about business property section 1231. Because when you have a loss, it becomes all of a sudden ordinary loss. Okay, and if you have a gain, you use it as a long-term gain. So long-term gain is better, right? Better tax rate. So here, let's read it one more time. Just by definition, real and depreciable business property are not capital asset. Capital asset is something that is personal, right? Capital asset is personal. However, under certain conditions, disposing of real and depreciable business property held for 1 year can result in long-term capital gain. Long-term. So you sold it for held for over 1 year is long-term capital gain, and long-term capital gain has a good tax rate. The disposal of real and depreciable business property held 1 year or less always produces ordinary income or loss. Ordinary income or loss. Real and depreciable business property held term is known as Section 1231 property, which I told you, if it's a real estate, it's 1231/1250. If it is not a real estate, then it is Section 1231/1245. So the sale, exchange, or condemnation of Section 1231 property produces a Section 1231 gain or loss. If Section 1231 gains for the year exceeds Section 1231 losses, the net Section 1231 gain may be treated as, that's the word, may be treated as long-term gain, which is really good. You want that. Long-term gain is good. If Section 1231 losses exceeds Section 1231 gains, then net Section 1231 loss is treated as ordinary loss. Ordinary loss is also good because you can write it off against ordinary income. Business casualty or theft gains and losses. Chapter 10 presented the rules for computing business casualty, theft, or losses. At the end of the year, taxpayers sum all casualty and theft gains and losses from Section 1231 property, which is a business property held long-term. When gains exceed losses, you know why? Again, let's highlight this word one more time, so kind of emphasize it. So what is a 1231 property? 1231 property, it's a property that you use in your business, but has a long-term life. It's not like 6 months life. Make sense? Okay, long-term life, like what? Like furniture, like building. Okay, furniture has maybe, let's say, for example, what, 5 years life, 7 years life. Furniture has 7 years life. Automobile has 5 years life. Computer has 3 years life. So all of them are longer than a year. Building depends if it's residential or commercial. Residential, 27.5 years life. Commercial, 39 years life. So all this that you hold it for long term, that will become Section 1231 property. And as soon as you tell me I have a section 1231 property, my next question is that section 1231, is it 1245 or is it 1250 property? If it's a building, you say 1250 property. If it is not a building like a computer or whatever, or furniture, then you say, no, it's 1245 property. Okay. When gains exceed losses, the excess is net business casualty or theft gain. Okay, when gain exceeds losses, then it's a gain. Net business casualty gain is treated as a section 1231 gain. When losses exceed gains, the difference then becomes loss, theft, business casualty or theft loss, because loss is higher. A net business casualty or theft loss is treated as ordinary income. Casualty and which ordinary income, I like it because you can write it off against ordinary. Ordinary loss is good because you can write it against ordinary income. So for the year, Leslie recognizes $10,000 business casualty gain and $4,000 business casualty loss from properties held long-term. So gain is 10,000, loss is 4,000. She also recognizes $2,000 section 1231 loss. Leslie treats 6,000 net business casualty or theft gain, which is 10,000 minus 4, it is 6,000, as a section 1231 gain. Leslie net section 1231 gain is 4,000 because 6,000 here and we have a 2,000 here. This is a 6,000 gain minus 2,000 loss. So we end up with 4,000 section 1231 gain. She may be able to treat the 40,000 as long-term capital gain in the netting process if she needs to net it with something else. If she's not netting with something else, and that's the end of the story, then that will be treated as a favorable tax rate, and she will pay the tax rate of either 0, 15, or 20%. Demi has 6,000 business casualty gain, 13,000 business casualty loss. So now this time loss is bigger, and the 5,000 section 1231 gain. So let's go here first. So Demi's net business casualty loss equals to 7,000, which is 13 loss minus 6,000 gain. Okay, hold on to that 7,000. She deducts the 7,000 from gross income as ordinary loss. So that loss is against ordinary income. You can write it off. That's because you treat it as ordinary loss, then you can immediately write it against ordinary income. Demi may be able to treat the 5,000 net 1231 gain as long-term capital gain. So you don't want to net them together. Make sense? Why not? Because in this situation, the loss, it is considered ordinary loss. And if something is ordinary loss, immediately you write it off against ordinary income. And that's really good because your tax bracket might be 37% tax bracket as an ordinary person, normal person, right? A normal person tax bracket is what? Between 10% all the way to 37%, right? So if you are a higher tax bracket taxpayer, this is a really good opportunity of $7,000 so-called ordinary loss to be written against ordinary income. Okay, you did that. Now, the $5,000 capital gain, section 1231 gain, can be long-term capital gain, and you show that separately and take advantage of that favorable income tax rate of 0, 15, and 20. And what's the difference of these two scenarios? Did you see the difference? Here you have the $6,000 gain. You see, 10,000 here is gain, 4,000 loss. So 10,000 minus 4,000 loss, that gives you a gain. But in this example, in step one, you got a loss, and that is ordinary loss. So you're gonna use that ordinary loss as soon as possible against ordinary income. For depreciation recapture, we talked about this again last time at the beginning when I was covering this portion. Just in short, when you have a depreciable property and you depreciate that, and then you sell it for a gain, the part that has been depreciated against ordinary income previously, that part, now it's ordinary income. Because you have a capital gain there, right? You cannot say the whole thing is capital gain, and I'm going to use my favorable tax rate of 0%. You have to recapture the portion that you depreciated. IRS says recapture it. So you recapture it, and the recapture portion of whatever you depreciated last few years, and you enjoyed it so much, now that portion, because you have a capital gain, it will be taxed as ordinary income. The remaining will be taxed as capital gain. So here is a very long example. I wish it was a shorter one. Here I have a shorter one. So let's go over this. If a property was initially purchased for $150,000 and the owner claims depreciation of how much? 30,000. So what's the adjusted basis? 120. Makes sense up to here? For the property is considered 120,000 adjusted basis. The property is subsequently sold for 185,000. So 185 minus 120, that's $65,000 gain, right? And you want to say, oh, that's long-term capital gain? IRS says, no, wait. You have $65,000 gain, but out of that $65,000 gain, you have $30,000 recaptured, depreciation recapture here. So since the property has sold for more than the basis that had been adjusted for depreciation, the unrecaptured section 1250 gain, and you know why is section 1250 gain, right? What is section 1250? Section 1250 is section 1231/building, real property. That's why it's section 50 gain. Are based on the difference between the adjusted cost basis and the original purchase price, which is $30,000. This makes the first $30,000 of profit subject to unrecaptured section 1250 gain. And why the remaining $35,000 will be taxed at regular long-term capital gains. $35,000 will be taxed at favorable 0%, 15%, 20%. The $30,000 that you recapture will be taxed as ordinary income.
So was it a good idea to take that depreciation or not? Like, how does that work out financially?
Normally, very good question. If you have a building, you cannot say, you know what, I don't like to start depreciation this year. I'm gonna wait another 2 years. Right now, I don't need that much depreciation. I'm gonna wait. IRS says either use it or lose it. That means if you don't depreciate it at all, still IRS will say, in this scenario, for example, still IRS will say, oh, you depreciated $30,000. And then you can say, swear to God, I never depreciate that. I decided not to depreciate. IRS says that was your fault. You either depreciate or I will depreciate it for you and you get no benefits out of that. Make sense? So you cannot say, I don't like to depreciate because such a thing may be happen. So you have to depreciate it no matter what. Yes, you have the choice to say, I want straight line depreciation, 27.5 years for residential property, well, let's say, or I want accelerated depreciation, let's say. But you cannot say, oh, I don't want to depreciate at all. So this part, it is depreciated no matter what. So $30,000 out of 150 gives you adjusted basis of 120. When you sell it for a gain, IRS says, okay, the part that you recapture from the depreciation and you wrote that off against your ordinary income, now it's time to pay ordinary income tax rate. But the remaining capital gain, yes, no problem. Go ahead and use this long-term capital gain for your advantage, which is 0%, 15%, or 20% based on your income. Make sense? Okay. Yeah, it was a complicated chapter, I know. That's good enough for now, I think. Let's continue the next chapter later on next week. And for this week, we prepare tax returns.